Stop refreshing that price chart, stop screaming into your pillow, and definitely stop texting anyone about selling the dog to cover losses. What you're witnessing on your screen isn't a market crash, it's a crime scene. While the price says panic, the vault data says bank run. If you're feeling fear right now, you've fallen for the trap. You're watching the puppet show while the theater burns behind you. It's Friday, January 30th, 2026, the end of the month, and the powers that be just threw a party. They invited silver to a red wedding and clubbed it from over $120 to under $90 in 24 hours. Gold nosedived. To the uninitiated, this looks like the end. The bubble popped. But if you wipe the tears from your eyes and actually look at the ledger at the delivery notices issued this morning, you'll see something that defies all logic. This price crash isn't a sell-off. It's a desperate, failed attempt to stop a nuclear explosion in the precious metals market. What you're seeing on the screen is a masterclass in market manipulation, not a genuine sell-off. When silver plummets from $120 to $90 in a single day, losing 25% of its value, the mainstream media immediately writes the obituary. They want you to believe thousands of investors woke up this morning and suddenly decided they hate making money. But that's a lie. This vertical red line, this $30 haircut, wasn't natural market movement. It was a coordinated smash executed with military precision. The proof isn't in the price. It's in what happened simultaneously in the physical market. While paper prices crashed, delivery demands skyrocketed. If this were a real sell-off driven by fear or changing fundamentals, you'd see the opposite pattern. People would be running away from physical metal, not demanding it in record quantities, but that's not what happened. Instead, the entities with real money, the whales and sovereign wealth funds, looked at the crashing price and said, "Give me my gold anyway." They know the knife is fake, they know the price is manipulated, and they know that physical metal is worth more than any amount of paper dollars, regardless of what the ticker says. The smoking gun came this morning on first notice day, the day of reckoning when futures contract holders must choose, roll their position and stay in the paper game, or stand for delivery and demand physical metal. Usually when banks smash prices right before this day, it's to scare investors into rolling over, into running away from delivery. They paint the tape red to trigger choice A. But today, despite the price massacre, the longs didn't run. They stood their ground, crossed their arms, looked the banks in the eye, and demanded their gold. The official data from the CME Group shows a staggering 20,484 delivery notices issued on day one for the February gold contract alone. That's 2,400 ounces of gold, roughly 63 metric tons changing hands in a single instant, moving from shorts to longs at the exact moment the price was crashing. Think about that psychology. If the price is truly crashing due to falling demand, why would anyone take delivery of 2 million ounces of a falling knife? This is a 10 standard deviation event, a black swan that proves the futures market's mechanism designed to deter delivery has completely failed. This massive volume is a vote of no confidence in the paper system. The fingerprints all over this crime scene belong to JP Morgan, the biggest player in the delivery game. The House of Morgan issued 11,959 delivery notices, meaning they're coughing up 1.2 million ounces of gold, feeding the beast and emptying their vault to satisfy demand. But here's where it gets interesting. JP Morgan is never just on one side of any trade. They're an octopus with tentacles everywhere. While their house account issued 11,000 notices, another arm of JP Morgan, likely acting for clients or a different desk, stopped for 7,995 contracts taking delivery back. They gave away 11,000 and took back 8,000. Net result, they bled 3,000 contracts. But the massive volume on both sides reveals the shell game. They're trying to confuse the flow, make it look like normal market activity, when it's really just them moving gold from their left pocket to their right, while frantically trying to fill orders for Deutsche Bank clients and UBS clients demanding the real stuff. Deutsche Bank issued 2,387 notices. UBS issued 2,379. The European banks are being drained, and gold is leaving London and Zurich. This churning, this chaos, is desperation masked as liquidity. The timing of this massacre wasn't accidental. It was strategic end-of-month window dressing. Today is January 30th, the last trading day of the month, and that matters enormously because bullion banks must report their books to regulators at month's end, marking their positions to market. If silver closes the month at $120, banks like JP Morgan, Citibank, and HSBC are sitting on billions in unrealized losses on their short positions. Their capital requirements explode. Risk managers start screaming. But if they can smash the price to $90, even for just one day, just for the closing bell, their books look magical. Losses disappear. Capital ratios look healthy. Regulators smile and walk away. They didn't smash the price because silver's fundamental value changed overnight. They smashed it because they needed to paint a pretty picture for the auditors, to window dress their balance sheets and avoid the regulatory nightmare that comes with holding massive losing short positions. This is financial engineering, not market forces. It's the equivalent of cleaning your house 5 minutes before the inspector arrives and hoping they don't look in the closets. When the price hit $90, every rational investor had the same instinct: buy the dip. If you like silver at $120, you should love it at $90. It's the sale of the century. So investors picked up their phones, opened apps for JM Bullion, APMEX, SD Bullion, ready to back up the truck, but they didn't see a buy button or confirmation screen. They saw error messages, spinning wheels of death, and in JM Bullion's case, a polite notice saying the site was down for scheduled maintenance. Scheduled maintenance on Friday morning during the most volatile session in history? This wasn't maintenance, it was a circuit breaker. The dealers pulled the plug because they knew that at $90, demand would be so overwhelming that the tsunami of buy orders would wipe out their entire inventory in 10 minutes. And they couldn't hedge it with the price crashing and markets chaotic. They couldn't buy paper contracts to offset their physical sales. So they shut the doors, turned off the lights, and hid. And it wasn't just U.S. dealers. Reports from London indicate the LBMA's electronic matching systems went offline due to technical difficulties right as the smash began, effectively locking out Asian buyers and Chinese arbitrageurs ready to buy everything. This is the definition of a rigged market. When the price goes up, they hike margins to stop you. When it goes down, they turn off the website. While websites were dark and paper prices crashed, a silent crisis unfolded in every coin shop in America, a crisis of constitutional silver, the pre-1965 dimes, quarters, and half dollars known as junk silver. This is normally the lifeblood of the retail market, the most liquid, recognizable form of silver in the world. But in the last 48 hours, it became toxic, not because it isn't valuable, but because refiners stopped buying it. Major refineries running at 110% capacity told wholesalers they only want pure industrial scrap, not bags of dimes that take too long to refine and slow down furnaces. This created a massive bottleneck. Local coin shops sitting on mountains of 90% silver couldn't sell to wholesalers because refiners wouldn't accept it, so the shops ran out of cash. The bid disappeared. Walk into a shop to sell your stack and the dealer might turn you away, not because he doesn't want the silver, but because he's literally illiquid. The plumbing backed up, the toilet clogged. This was the liquidity trap working perfectly. Price crashing, websites down, local shops broke, panic everywhere. This is when a whale named David Bateman stepped in with $200 million, looking at dealers drowning in 90% silver they couldn't sell and seeing the opportunity of a lifetime. We're now living in a world that's completely decoupled, where geography determines your wealth and 3 different price realities exist simultaneously. Reality number 1 is the New York price, $108 silver, $5,200 gold, the fake reality. This is the price set by paper contracts, manipulated by algorithms and suppressed by banks terrified of the dollar's collapse. It's a price where you cannot get delivery in volume. It's a mirage. Reality number 2 is the world price, the London and Mumbai price, $118 silver, $5,500 gold, representing fair value where physical metal actually changes hands between rational actors. This is the true global consensus before manipulation kicks in. Reality number 3 is the China price, $132 silver, $5,600 gold, the hard floor. This is desperation pricing, what happens when you have 1 billion people and 0 inventory. This price acts as a black hole, sucking every ounce of metal out of the West. The tragedy is that millions of Western investors are looking at reality number 1 and making decisions based on it, selling their metal in panic. And who's buying? Reality number 3. Every time an American sells SLV shares or physical bars, Chinese entities are buying those ounces at a discount and shipping them to Shanghai. You're not just losing money, you're transferring generational wealth to the East. The ultimate irony in this entire manipulation is that even the banks executing the smash are privately admitting the game is over. While JP Morgan's trading desk hits the sell button, smashing gold prices down, their research department is telling high net worth clients behind closed doors that gold is heading to $8,500 per ounce. A research note from JP Morgan's lead global strategist Nikolaos Panagiotis just hit Bloomberg terminals with a forecast of $8,500 gold. That's 63% upside from current levels of $5,200. Why is he bullish? Because of allocation shifts. The implied allocation of private investors to gold has risen to 4.6%, and in a world where trillions slosh around in bonds and stocks, a move from 1% to 4% represents hundreds of billions moving from paper to hard assets. The bank knows pension funds, sovereign wealth funds, and family offices are losing faith in debt markets and moving the dial. So here's the dirty secret. JP Morgan knows the price is going to $8,500. They know $5,200 is a joke. They're smashing it today to accumulate, playing a double game where they crush sentiment in paper markets to make retail investors sell ETF shares so they can scoop physical metal at a discount before the inevitable run to 8,000. It's the classic Wyckoff spring, a terminal shakeout where they drive prices below support to trigger stop losses, flush weak hands, and generate the liquidity they need to build long positions. Here's the verdict. We've walked through the crime scene of the century, examined the fingerprints, identified the weapon, and named the victim, the price discovery mechanism of the United States, bludgeoned to death by a desperate coordinated attack designed to paint a false reality. You have three choices today. You can believe the New York Mirage at $108 silver, accept the world's fair value at 118s, or recognize China's hard floor at 132. The spread is the first crack in the dam, signaling that the LBMA and COMEX are losing control. They can smash paper prices, but they cannot smash physical demand. Do not let a red candle in the New York session shake you out of a green reality in the rest of the world. If JP Morgan thinks gold is going to $8,500, why would you sell at $5,200? If the Chinese government is paying $130 for silver, why would you sell at 108? Use the manipulation to your advantage. Buy the subsidized metal because this window won't stay open forever. Eventually, the arbitrage bots will turn back on, the metal will run out, and the three prices will merge, not at 108 but at $132 and higher. The game is rigged. The spread is real. Don't sell to China. Hold the line.